Hey guys, how's it going? So today we're going to go through a couple of the basics of student loans. Specifically, we're going to be going over the private versus federal student loans, federal loans, the different types between there, how to get those loans, and then going about repaying back those loans, as well as some of the forgiveness options that are out there. So let's go ahead and talk about the differences between private versus federal student loans. First off, there's a lot of things that actually overlap, and so they have a lot of similarities, but there are some key distinctions between the two of them. Mainly the repayment options as well as the interest rates. Federal student loans have fixed interest rates that are set by the federal government. So whenever you receive a loan from the federal government, that interest rate is going to follow that loan for the life of the loan, as long as you don't consolidate it. Versus the private loans, whenever you receive a private loan, can have a variable amount or a variable interest rate, meaning that 1 month it could be 4% and then the following month it could be 6%, and so it can change. There's a lot of private loans that also have fixed interest rates, but sometimes they can be a lot higher than what the federal government has set up. The other distinction between these two loans is the repayment options. Now, federal loans have much more repayment options, including something that's known as income-driven repayment plan, where based upon your family size and how much you're making will determine how much you're going to be paying month to month. The other thing that makes the difference between private loans is that some private loans actually will penalize you if you start paying back your loans earlier. And so whenever you're getting out your loans, that's one of the things that you want to look into is what are the fees that are associated with it, what are the repayment options, and also what are the interest fees are going to be with you. Are they variable? Are they fixed? And so those are some key distinctions that you need to make whenever you're going into pulling out money for your student loans. All right, so let's go ahead and talk about how you're going to go about getting these loans. With federal student loans, you need to fill out a form which is known as the FAFSA form. FAFSA is an acronym that stands for Free Application for Federal Student Aid. Now, there's a huge emphasis on free, mainly just because there's a lot of institutions that are out there that are willing to charge you a fee in order for them to fill it out for you. You don't need to do that. I'm sure there's plenty of people that are on your campus that can help you through it, as well as your financial aid office that will be able to walk you through how to go about filling it out. Don't pay anyone to do it. You can go online and they have the forms there. You can print them off or you can fill them out online. There's also an app that you can use. I believe it's called the My Student Aid app. Just go on, find that. It's available for Android and Apple. So that's one of the ways that you can go about filling it out for FAFSA. Then there's private student loans. Private student loans you can either get through a credit union, a bank, state agency, or school. And whenever you're filling these out, most of them require a decent credit history. If you don't have that or you don't have a history at all, usually you're going to have a cosigner with you. And so those are some of the key differences between federal loans versus a private loan. So let's go ahead and dive a little bit deeper into federal student loans. So there's a lot of different loans that fall underneath federal student loans, including direct subsidized loans, direct unsubsidized loans, then there's direct plus loans, then there's direct parent loans, as well as Perkins loans. Now, as of September 30th, 2017, Perkins loans are no longer available to students, and so the schools no longer have the authority to give those out. And so we won't be talking about that too much more, but we'll talk about some of the repayment plans later on. Before you receive your federal loans, they're going to have you do something that's known as entrance counseling or signing a promissory note. Essentially, you're promising that you're going to be paying back those loans regardless of what happens. And so before moving forward, that's what's going to happen. As soon as you fill out your FAFSA form and you get approved for it, they're going to have you fill out a promissory note before any of the loans are dispersed to you. So let's first talk about the subsidized loans. Subsidized loans are given to any undergraduate student who can show financial need. And then the school determines how much loans that student receives. And then from there, the nice thing about these loans is that while you're in school, they still accumulate interest. However, the Department of Education actually pays down any interest that accrues during that time. And also in some cases, they also pay down any interest that accrues during your grace period, as well as any times of deferment. There are a couple instances where they don't do that. So if you received a direct subsidized loan that was first dispersed between July 1st, 2012 and July 1st, 2014, you will then be responsible for paying any interest that accrues during your grace period. If you choose not to pay the interest that accrues during your grace period, the interest during that period of time will be added to the principal balance. And this is something that's known as loan capitalization. And I've talked about it in another film, but essentially what happens is the interest that is accruing on the principal amount will then be added on there. So that's called loan capitalization. And now essentially this new principal balance is going to be a lot larger, and the interest that's accruing on that on a day-to-day basis is going to be much greater than if you were to say pay off that interest before it was capitalized. That's one of the main things about subsidized loans during that period of time. Then there's direct unsubsidized loans. Now these loans are dispersed to undergraduate, graduate, and professional students. These loans typically have higher interest rates than the subsidized loans, and you don't need to show any financial need. Interest accumulates while you're in school, and any unpaid interest will be capitalized at the end of the grace period. Also, any interest that is gained during a deferment period or a forbearance, these loans will also, or the interest will also be capitalized to the principal amount of your loan. Next, there's direct plus loans, which have the highest interest rates and are available to graduate and professional students, as well as students' parents. These loans also require an additional counseling where the student not only needs to complete the promissory note for any unsubsidized and subsidized loans, but they also need to complete something that's known as a master promissory note, which essentially means that you promise to repay again the loans regardless of if you completed your education, couldn't find a job, or didn't feel like you got your money's worth for the education that you got. One of the differences between direct plus loans as well as the other ones is that the borrower must not have any adverse credit history. Also, like the unsubsidized loans, these loans will also accumulate interest while in school. During the 6-month grace period, it'll also accumulate, and then during any times of deferment and forbearance, if there is any interest that accumulates that you don't pay back, it'll also be capitalized. Each one of these loans is going to be distributed to you from your school for the intention of paying for school, housing, and your books. Then you must complete exit counseling, which occurs anytime that you graduate from school, leave school, or drop below half-time enrollment. And it's during this time that it's really stressed the importance of paying back your loans in a timely manner and how not to default on your loans. So let's go ahead and let's jump right into how you're going to go about paying back these loans. Now there's many ways that you can go about paying off these loans, including loan forgiveness programs that are available for teachers, nonprofit organizations, and individuals that serve the public. I've included a link below that has the details for these programs, as well as a lot of forgiveness programs that are for federal Perkins loans. But let's say that's not the path that you wanted to go and you want to actually repay down your loans. There's a lot of different repayment options. One of the most common ones that you're first usually introduced to is the standard repayment plan. The standard repayment plan essentially puts you into a plan where you're going to be paying back your loan within 10 years, and it's going to be fixed month-to-month payments until it's all gone. Then there's graduated repayment plan, which again, the graduated standard repayment plan ensures that you pay back your loan within 10 years. However, it's going to be putting less payments at the beginning, and it's going to slowly ramp up until you pay it off in 10 years. Then there's the extended repayment plan. This one can be fixed or graduated over a 25-year period. Now you can also set up a consolidated loan for the standard repayment plans as well as the extended repayment plans, and that can extend your 10-year repayment plan all the way out to 30 years. Essentially, you need to contact your student loan servicer to kind of talk about how you're going to go about getting consolidation loans to make that happen. But these loans can be anywhere, again, from 10 years to 30 years. Then there's the income-driven repayment plans, which fall under 4 different repayment plans. There's the Repay, Pay, IBR, and then ICR. Each one of these repayment plans are based off of your discretionary income, which discretionary income is defined as the difference between your annual income and 150% of the poverty guideline for your family size and the state of residence. So an example of this would be a family of 4 earns $50,000 per year, then referencing the poverty guideline, which turns out to be $25,750. Then you take 10% of that difference between the annual income and 150% of the poverty guideline, which turns out to be $1,138. Each one of these repayment plans can range from 20 years to 25 years depending on the repayment plan and if the loans were received during undergraduate, graduate, or professional study. Under all 4 repayment plans, at the end of the 20 to 25 years, if you have any remaining balance that's left over, it's going to be forgiven by the Department of Education. However, there's one key thing that you need to note is that anything that's forgiven is considered taxable income by the IRS. And so just be mindful of that. Thanks for watching to the end of the video. If you have any comments, please leave them down below. If you haven't already, go ahead and like and subscribe to the channel. Thanks for watching, guys.